Thank you for joining me. Today I want to go over how to invest for dividends. And this is a video mostly for beginners because dividend investing has a certain allure to it. You're basically spending money to buy passive income. You buy a few stocks, and then every 3 months you get money for free, like after you bought it, obviously. But the the practice of it is not quite as simple, and there are certain things you need to watch out for to not buy the wrong stocks and somehow still manage to go broke. So these are, you need to look at the dividend and dividend yield. Obviously, that's going to be the most important point for people who want to get into dividend investing because that is the actual money that you have coming in. Now, Ford right now is at almost 6% dividend yield, which means if you buy one share of $10 or slightly above, you get 60 cents per year in dividend. Now, that is per quarter, so you get 15 cents per quarter. So if you wanted to buy at least one share every quarter, you need to invest about $700. And then when the dividend comes in every quarter, you can buy another share and have the compounding effect, which you wouldn't get otherwise. So if you invest less than the money to where every quarter you can pay at least one additional share, you don't get the compounding effect that you get from the general stock market because, you're not increasing the number of shares. So the only way to increase the money coming in would be if the company increases their dividend, which does happen to most, if not all, of the dividend paying companies, but probably not every year. And in really bad cases, they might even cut the dividend, and that tends to push the stock down quite a bit. So you're losing doubly there. So after the dividend yield, you need to make sure that revenue is growing. So if the revenue is not growing, if it's shrinking, then obviously after a while they won't be paying the same amount of dividend because they can't. So make sure revenue is growing, make sure the profit is growing. The reason that I would look at both is that profit is much easier to grow than revenue, at least on a short-term basis. If the revenue is growing by 50% every year, it's way easier to make the expenses grow far less and thus majorly increase the profits. There's companies that increase their revenues by 10% and that increases their profit by 20% because the expenses are not growing. So obviously hard to find companies like that, but those two things are very important points. So after that, you need to make sure to hit the like button, and then you need to look at the payout ratio. Now, Walmart, for example, pays out over 90% of their profit to shareholders, and they've done that for a long time. And with a company like Walmart, that is not a terrible thing, but that's a case-by-case basis kind of thing. So any money that gets paid out to the shareholders obviously can't be used to grow the company. So Walmart cannot really invest, half of the money coming in to grow their business and grow their revenue. But they already have $500 billion in sales every year, so there's a fairly limited room for growth without, even if they weren't paying out major money in dividends. So the payout ratio kind of determines how fast the company can afford to expand their business, if they need to buy factories and machines to increase their productivity, their output, if they're producing something. That obviously won't be happening if they spend 100% of their money on the shareholders. So make sure the payout ratio is reasonable compared to the growth at the very least. So if you want the company to grow, or if you need the company to grow, then obviously the company needs money to do that. And if they're paying out 95% to shareholders, they probably don't have the money for that, and they obviously need kind of a buffer in case the profit goes down. So look at the dividend and yield. The dividend is the monetary value they pay out. The yield is the percentage. As I said, with Ford, they pay out 60 cents, and the yield gets adjusted to the current share price every minute, every second, every whatever. So the yield might fluctuate wildly while the dividend stays the same. So if Ford goes up to $15 a share, suddenly they're not paying out 6%, they're paying out 4%. And they're still paying out the same amount. So if you bought it at 10% and it goes up to 15%, you haven't lost anything because they pay out the same amount per share. It's just that the amount they pay out in relation to the share price gets lower, which again, if you're not interested in buying at that point, it doesn't affect you at all. Now, if the share price goes down, then you would lose money if you were to want to sell that stock. But a dividend strategy kind of centers around the fact that you're not selling at any point. You're just buying the stock, and then you enjoy the free money that you get every quarter. So don't worry about the stock price, the share price. Don't worry about the share price. It doesn't affect you what the share price is doing. Just enjoy the money coming in, and do keep an eye on the revenue, the profit, and the payout ratio. Make sure that those are all numbers that you're still comfortable with, or at least the outlook. And other than that, just hold it. Don't worry about it. Just keep it locked away. I wouldn't really watch the share price at all. Just watch the news, watch where the revenue and the profit is going, and yeah, that's basically it for investing for dividends. And as I mentioned, Ford is a pretty nice stock because it's literally $10. It's it's probably $10.50 or something right now, but it's around $10. So for just $700-ish, you can have a portfolio that allows you to buy an additional share every quarter if you're using Robinhood. If you're using a standard broker, then you're paying at least $5 to buy that additional share. So you need $1,000 right now, or 100 times what their share price is. And then you spend literally 30% of your profit every month, every quarter to buy another share, which is not really economical. So if you don't have $1,000 to invest, stick with Robinhood. Stick with something that does not charge you fees for trading. If you're going towards the $2,000-ish barrier, with a high dividend yield stock, it shouldn't affect you that much. At that point, it's 15%, which is bad, but it doesn't really affect you that much. You're still getting that compounding effect. So yeah, you always want to grow your dividend portfolio. And obviously at that point, I suggest anytime you get a dividend, you throw more money into the stockbroker account in the first place, and then buy more shares with both the dividend yield and the additional money you just threw in. So make sure to subscribe, and I'm coming out with new videos every day before market open. I hope you have a successful day.